Good evening, traders. It is Wednesday, June 3rd, and it's time for the weekly swing trading video. We've had quite a market rally during the last few days. After the holiday, the market started to grind higher. Everyone's really encouraged about the economy reopening, so we're going to be focusing on the long side. Our current positions are doing extremely well, and this week we're going to be looking for more bullish put spreads to sell. We really want to take advantage of that time premium decay. We're seeing a decline in option implied volatilities. That's also working in our favor when we sell option premium. So we've got those two forces working in our favor. I do feel that the market's getting a little overextended, so that has me a bit concerned, but I don't see any speed bumps coming in the course of the next 4 weeks because we're going to be waiting for information as the economy reopens. So right now, everyone's erring on the side of being long. We have asset managers wanting to be in equities. It's really a no-lose situation for them because if the recovery does start to struggle, then they know that the Fed is going to step in with more quantitative easing. They also know that Congress is likely to pass a stimulus bill. The House has already passed a $3 trillion bill. Republicans aren't interested in it, but Mitch McConnell has said that yes, if the recovery is struggling, that Republicans will sign a stimulus bill of some type. They're looking to really get the money to small businesses and to workers. So that's the safety net that's being provided not only in the US, but globally. Central banks around the world are printing money like mad. The EU is looking for a $100 billion stimulus program. Germany's trying to get one enacted. They weren't able to pass it. There's a $1.1 trillion stimulus package in Japan. It's happening everywhere. So I don't want to beat a dead horse because we're seeing stimulus and money printing across the board. Everyone's trying to avoid any kind of a financial crisis. So the market's continuing to float higher. Plus, with interest rates at 0%, asset managers have no alternatives. When they go into fixed income, the yields there are not keeping pace with inflation, so they're generating negative real returns. That's not where they want to be. They might as well put it in the market, hope for the best, hope that consumers start spending, hope that all the stimulus is working out, and have the knowledge that there will be more tools, more quantitative easing, and more stimulus if the economy starts to struggle. So that's where we're at. As far as the reopening of coronavirus, the states that opened earlier in the last 2 or 3 weeks have not seen a surge in new cases. Yes, the numbers are increasing, but that's also because we have a lot more people being tested. So they're identifying the coronavirus, but on a percentage basis, the numbers are actually coming down. And we're seeing that also happen globally. Yes, there are some hot spots around the world, but the virus concerns are diminishing and we've got the economy reopening. Almost all the states are at least in phase 3 right now of the reopening. So the economy should start clicking along. You can see here that we had this breakout above the 295 level. That was a significant resistance level, and now that's become support. That level also happens to coincide with the 100-day moving average, so we'll put that up. This is the big support level. If the SPY closes below 295, we have to buy back our bullish put spread. So every single bullish put spread that's out there, just buy them back. If they're profitable, great. If you're down a little bit, great. Just buy them back in because a breakdown of that magnitude would tell me that there's some really bad looming news and that the market is going to roll over. By the way, there was another news event, and that was that tensions between the U.S. and China were starting to flare up again and that there might be possible trade sanctions. Well, in his press conference last week, President Trump did not say that there were going to be new trade sanctions. He simply said that the U.S. is going to be withdrawing from the WHO. That was the big news. The market sold off a little bit last Friday. Everybody was fearful that there might be some kind of rhetoric coming. Listen, folks, President Trump wants the market to rally. He's already said it. Every time he speaks, he's talking about people's 401ks. He wants a strong economy. He does not want to start causing friction with China into the election. So I don't think we're going to hear anything about tariff increases from now until the election. So it's all systems go. Am I rah-rah bullish, horns popping out of my chest? Absolutely not. I think that we're getting to a point right now where we're overvalued. We have corporations, almost every CEO has said Q2 is going to be worse than Q1. And so earnings season is still about 6 weeks away. I think that the market will continue to try and float higher. Look at this minuscule little volume here. You can see that this is a light volume rally. Well, a word to the wise, light volume rallies can easily be stripped away. As good as all this price action looks, one ugly day can take all of that away. And so we need to be very, very careful because as the market rallies higher, we're seeing a decline in option implied volatility. So I'll put up VXX and you can see how that's been coming in and coming in and coming in. Now that means that at some point in time, the good news is that we might be able to try some buying strategies pretty soon, but I'm really looking to the fall for that. And the only time I would really want to buy premium would not be on the bearish side, but it would be on a bullish pullback, excuse me, on a pullback in a bullish market, and then trying to buy some of these stocks that have a real opportunity to rally into year end and buying some longer term options. We're far, far away from that right now. Don't get excited about buying option premium. I think that we've got a lot of work to do between now and then. So as far as I'm concerned, I see that somewhere in here there's going to be a speed bump. The market's going to pull back, probably test that 295 level. It's okay. Our bullish put spreads, if we're selling them inside of that 2-week window, which is what I plan to do, we're able to reevaluate every couple of weeks. The spreads that we have on right now, they're all in really good shape and they're way out of the money. So time is already working in our favor. And so every week, we might have 4 spreads that we try and put on. We may only get filled on 2 of them. That's okay. I don't want a lot of exposure right now because I want to wait for one of those dips and then I want to reload. And if we never get a dip, that's okay too, because our current positions will generate nice income while we wait. I see this as a low probability trading environment. I feel that the upside rewards are much smaller than the downside risks, so we need to be careful. Now, last week's video was pretty long. I'm going to try and keep this one fairly short, so we're going to get right to it. And here you can see that I've got 2 trend lines that I drew. There's an upper trend line and a lower trend line. As long as the market stays within this trend line, I think we'll be okay. But if we start seeing green candles that start poking up above it, that's when I think we might have a bullish climax. That's when I think that we're in danger of maybe seeing a pullback. And if bullish sentiment has gotten too far ahead of itself, you could have bullish speculators flushed out, and it could come down and at least challenge this 295 level, which would be that upward sloping trend line as well. So that's something that we have to watch for. We don't need to be careful about it just yet, but things are getting a little bit frothy in here. If we start seeing a couple really strong days and we get up anywhere near that 324 level, I think it's time to go to the sidelines, wait for a technical breakdown, and then look for a shorting opportunity because the market will have been way ahead of itself. And if you look at some of the stocks that rallied today, I mean, come on. These are the laggards. These companies are going to have a long, hard road back. And they're rallying today like there are no issues. The street tends to call that the dogs are barking. That's the label that they put on it because all the laggards start moving, and that's usually the last leg of a rally, is when you start to see a rotation out of the leaders and into those laggards, then you know that you're in the final phases of the current leg of the rally. So you need to be a little bit cautious. I'm not overly concerned. We're going to have some really nice spreads on. I've been able to identify some good stocks, and that really is the key right now, is identifying the right stocks. So let's take a look at what we've got on. I'm going to put this chart up, and this is the staged order screen, and I'm going to go through the yellow ones. You'll see cancel by the yellow. Those are going to be coming off tonight. I'm going to remove them from the staged order screen. Last week we're not able to sell the Walmart June 12 118 put spread, buying the 117s, doing that for a 20-cent credit. Couldn't get filled on it. Nvidia, we weren't able to get filled on either. We're trying to sell the June 300 puts and buy the 297 puts for a 50-cent credit. Could not get filled. So we're going to cancel that order. And here we had the Twitter trying to sell the 2750 puts and buying the 27 puts for a 10-cent credit. I believe I left this one up in error from 2 weeks ago. We weren't filled on that, so that's going to be removed. As far as the other trades, we did have a couple of tenuous trades on last week that gave us a little bit of a problem, but everything wound up perfect. We had NVIDIA. There we were short the May 29 340 put. We're long the 337.50 put. And when I did the video Wednesday night, NVIDIA was slightly above that 340 strike. So not a problem. It had pulled back on Tuesday. It was in the money, but we were able to weather that one-day dip. And then by the close of Friday, NVIDIA was more than $10 out of the money. So no worries on that. We made a nice credit. Not quite a 25% return on that, but about a 22.5% return because we only took in a 40-cent credit instead of our normal 50-cent on a $2.5 wide spread between the strike prices. RNG, we put that one on about a month ago. I really like that stock, and all of a sudden it came in, and it came in hard. It was in the money for a couple of days, and then when it found support right at that level that I had mentioned, right at that 255 level, once it dipped below it and found support, it shot through it like a rocket, and that spread finished out of the money by at least 12 points. So on a swing trading basis, we really have to watch these spreads at the close. The intraday price action doesn't matter. The only exception to that would be if the SPY closed below 295 or traded below 295. Okay, now we've got the market falling apart, we've got the stock falling apart. In that instance, you could buy the spread back in on your own during the day if both of those conditions are met, but that's not how I'm going to be handling it here. I'm going to need to see a close below 295 on SPY, and the stock is going to need to close below that key technical support level that we identify originally in the video. So we had two really nice trades on that expired worthless, so that takes some risk off the table. And let's take a look at some of our other positions that we currently have on. VLO, we're short the $56 put and long the $55 put, and that is currently offered at 2 cents on the $60 put. So, I mean, you could buy this back for a penny, but you could even buy higher strikes back for a penny and close that trade down. So, for all intents and purposes, that's a winner. We've also got the BYND. Now, this was on a special video that I did. There we've got a 5-cent ask on the 108, 107 bullish put spread that expires this Friday. And that's a very wide bid-ask spread on that stock. You could buy that back for less than 5 cents for sure. And I believe that might have been a 5-cent ask on that 105 on that 108 put. So again, for all intents and purposes, this thing is toast with 2 days left. Tomorrow, Thursday, when you turn on your screen, if you can buy these back for pennies, buy them back. Get rid of them. You know, we sold that spread for 20 cents. If you can buy it back for a penny, do so. Same thing with VLO. Release the margin, release the risk, get the clutter out of there. You've milked that thing dry. There's nothing more to be made from it. Same thing with Facebook. Here we sold it for 50 cents. There's a 6-cent ask on that spread. If you can buy it back for a couple pennies, do it. That is the 215 put and long the 212.50 put. Again, that expires this Friday. So we're going to have a lot of positions coming off. Well, what exactly does that leave us with? Well, excuse me, it leaves us with our two trades from last week that we were able to get filled on. We had the Netflix 390 put, long the 385 put, and that we were able to do for a $1 credit. That's currently offered at 50 cents. So we're already making great money on that trade. That one expires on June 12th, so we got a little bit of time to wait on that one. And then we also were able to sell the PXD 85 put, bought the 84 put, did that for a 20-cent credit. Didn't have a price on that. The stock closed above $100 today. Toast. No bid, offered at 20 cents was the that spread. I don't know. You probably can buy that spread back for, I would imagine, a couple of pennies. Bid for it, but it's in really good shape. The only other one that we've got on is LVGO. And there you can see that we're short the 50 puts, long the 45 puts. That has a 40-cent ask on it. We got $1.15 for that spread. So really, really nice one. That one's going to yield probably close to a 32% gain for us. And you can see how those premiums are really coming in. You can buy it back for 40 cents. I wouldn't advise that. Leave it alone. Stock's way out of the money. Let the time decay continue on it. Don't need to touch it. So after this week, we're going to have Netflix, PXD, LVGO, all in really nice shape. So our risk exposure is very, very limited. And that's great. That's the way we want to keep it. So let's go into this week's screen. We're going to take a look at the trade screen, and then we're going to go right into the staged order screen. So I'm going to bring that up, and I'll show you the trades that I've got for you this week. So this is what it looks like currently, but realize that a lot of these are going to be coming off. I've got 3 of them I'm going to be removing tonight that I already showed you, and we've got a lot of them that are going to be expiring, so those will also be coming off. So these are the trades that we're going to be doing. You can see at the very bottom of the screen, I've got the new ones right here. All you have to do is click submit if you're using the broker API. For interactive brokers, for Tradier, or for Ameritrade, all you have to do is click submit. The order will be routed. Now, it's only for one contract, so you may want to adjust your contract up, but I wanted to keep the risk minimal so that if you click submit, there can't be any big errors that are made. So first on the list, we're going to take a look at MCD. Well, why do we like McDonald's? Look at that horizontal breakout right there. I love that. The stock has been able to hold up very, very well. You can see that today it closed on its high of the day. We've got a nice upward sloping trend line that almost comes into play at that 185 level. So for this particular trade, I'm going to bring up the trade screen. And here we are looking to sell the 185, 182.50 normal expiration. So we're going to bring up June 19. Click on the 185. Click on that 182.50. That's a 2.5 point spread between the strike prices. So, of course, we're going to be looking to get a 50-cent credit on that. You can see that that spread is currently 10 cents bid, offered at 69 cents. Can we get 50 cents right now? Probably not. Probably going to need to see the stock pull back just a little bit tomorrow, and then we'll be in range to get that done. Now, I like selling that spread below the $85 strike price because, look, we've got horizontal support here. We've got the 100-day moving average that we're leaning on. So I think that we've got plenty of cushion in here. McDonald's is not a big mover. You've got the economy reopening. Restaurant stocks have been hot. In fact, all the travel and leisure stocks have been really, really strong. Plus, McDonald's does a ton of carry-out business and to-go business. So for those people who don't want to dine in, they have that as an alternative. So I like McDonald's. I think that sets up really nicely for us. And I love that it's through that 100-day moving average. Let's put up that 200-day moving average just to see where it comes into play. And you can see that it's got a little bit of resistance getting up to the 200-day moving average. We're not too concerned about that because we're just concerned that that 100-day moving average holds. So that's the first trade that we've got. And let's take a look at the next one. I'll just reiterate, we're selling the June 19th 185 puts. We're buying the June 19th 182.50 puts, and we're doing that for a credit of 50 cents. So we'll go into staged orders. We'll take a look at the next one. Here you can see Qualcomm. We're going to be selling the regular expiration, $78 put, and we're going to be buying the regular expiration, $77 put. You should already be thinking, gee, there's a dollar between the strike prices, so Pete must be looking for a 20-cent credit. And you would be correct. So we're going to bring up Qualcomm. And actually, sorry about that. Let me bring up the stock. And let's take a look at why we might like this. We've got a really nice compression for a long period of time. right in here. The stock is finally breaking through that resistance. You can see how once it got through, it closed on the high. The volumes have been very, very good. It's above both major moving averages. That $78 put puts us right down on this compression, right at the base of the compression. I like that. We've got multiple support. We've got this horizontal resistance that is now support, and that's also about the halfway point of this long green candle. Okay, that's good. We've got the 200-day moving average. Okay, that's good. We've got the 100-day moving average. That's good. We've got a long green candle closing on its high. Fine. We got big volume coming in. The more check boxes that you can mark for each one of these trades, the higher your probability of success. So it's important that you don't have just one indicator that you use, or that you have one theme for taking a trade, that you have multiple things working in your favor. And you'll see that in almost every pick that I give you. So let's go into that normal expiration, June 19th. We're going to go down to the the $78 put. And there you can see it right there. And we're going to click on the $77 put right there. And you can see that the bid ask on this is pretty whacked out. So that would actually be a negative 47 cent on that credit spread, which is never going to happen. You wouldn't even do it for zero. But anyway, it's just because of the wide bid ask spreads. And Qualcomm tends to have pretty tight market. It's a fairly liquid stock and fairly liquid options. So negative 47 cent bid offered at 50 cents. Of course, we're going to be trying to get a 20-cent credit for this. So that's where we have our staged order. And we'll just review the trade one more time for you. So we're going to be selling the June 19th $78 put. We're going to be buying the June 19th $77 put, and we're going to be doing this for a 20-cent credit. And we'll take one more look at it here. 78, 77 put, 20-cent credit. All right, that's the next one. Qualcomm. AXP, move on to the next pick. AXP, nice little breakout here through the 100-day moving average. So the stock looks good. It's got this horizontal resistance level that is now support. We can lean also on that 100-day moving average. Now, here's something that you should consider when you're looking for your bullish put spreads. One day above the 100-day moving average, okay, that's fine, that's nice, but we'd rather see 2 or 3 days above a major moving average, because then that starts to confirm that support is there at that major moving average. But we're not going to be selling just below the 100-day moving average. We're going to be selling all the way down here where I believe that major horizontal resistance was and where the support is. So we're going to be looking to sell actually right in here down to the $100 strike price. This one's a little bit closer to the money. We're going to be selling the AXP June 12th, not regular expiration, June 12th. So we've only got a week and a few days on this one, and we're going to be buying the $99 puts. We're going to be doing that for a 20-cent credit. So that one's a little bit closer to the money. That one has more risk. And we're going to go in and take a look at that trade right now. So AXP, we're going to be going to June 12th. We're looking at the 199 bullish put spread. And so we're going to go in here, click that, whoops, click that. So you can see that it's currently 4 cents bid, offered at 40 cents. Well, we want a 20-cent credit on it, so probably going to need a little bit of help from the stock. It's going to need to pull back just a touch for us to have a chance at getting filled. You can see that the stock is at $105.40. So the key to this one, and this spread, because it expires June 12th, we're only going to try to get this trade executed Thursday and Friday. If you are not filled by the close Friday, cancel the order. I will repeat that. On the AXP trade, Because it expires June 12th, and because it is a much shorter term expiration, and because we are closer to the money, if you are not filled on this trade by the close of business Friday, cancel the trade. Do not try to enter it. Well, gee, Pete, if you like it now, why don't you like it next Monday or next Tuesday? The reason for that is because time decay will have already been working. And in order for us to get filled, the stock will probably have had to broken that 100-day moving average, and it will be heading south on that fill. I don't want that. A little mini blip down tomorrow and a fill, and then the stock continues higher. Yes, that's what I would ideally like to happen Thursday or Friday. But by next week, especially by Monday, because premium's going to be sucked out of those options over the weekend, by the time you come in Monday morning, you do not want a 20-cent fill on this trade because it means this stock is starting to head south and it's probably below that 100-day moving average. So on the ones where we're only in the trade for a week and a couple of days, we can only try and get that off Thursday and Friday, and then we got to cancel it. Okay, so I just want to make that abundantly clear. Let's take another look at that trade just to be clear on what we're trying to do here. We are going to be selling the AXP June 12th $100 puts. We're going to be buying the AXP June 12 $99 put. We're going to be doing that for a 20-cent credit. Good till the close Friday. Let's take a look at the last and final one that we're doing, SQ. AXP and SQ are similar in certain respects because they're transaction processors. AXP actually does have some credit risk because it does actually provide the credit card services to consumers, where SQ doesn't have that risk because they're simply transaction based. But AXP actually has typically attracted a higher net worth individual who probably be less susceptible to some of the hardships that we're going through with the coronavirus. Bank stocks have done really, really well recently, so the financials are catching a bid. AXP is going to be our way to play that. So SQ, we're going to be selling the $80 put and buying the $79 put and doing that for a 20-cent credit. So I'm going to put this off screen. Let's take a look at the stock. SQ has had a really nice breakout. We've played it before below these major moving averages when it broke out, made some money then. Now we've got a nice horizontal breakout, long green candles closing on their high. I believe this support level is going to hold, but the stock is fairly volatile. So what I'd like to do is I'd like to sneak in right underneath that support level right there. You see this bullish hammer right here? That's nice. Support, support, then the stock takes off. So I want to lean on that level, which is just below the breakout. So that would be our first warning sign for the stock would be a close below this open today. The next warning sign would be a close below this open the prior day, because that would also break below this technical resistance level that should have provided support. So we've got those two levels. If I start seeing those breached, then we're still out of the money, but we've got to consider buying that spread back, especially if it happens fairly quickly, because it'll mean that this is just a head fake move. I don't believe this is a head fake. It's got really good volume in here. That's a solid breakout. I believe this stock wants to move higher. That's why we're doing this trade. So almost all the bullish put spreads that we're putting on right now, because option implied volatilities have come in, we are looking for momentum. We are looking for that stock to move higher. That's only increasing our chances to make money on these. And so it's really a directional trade that we're trying to take advantage of. And because the premiums are coming in, the VXX is dropping, we're really needing that upward momentum. But because we're selling out of the money bullish put spreads, we've got some cushion. I mean, look, the stock is at $91. We're trying to sell a bullish put spread down here at the $80 strike price. So let's bring this up and let's take a look at where those options are currently trading. These are the regular expirations. So on SQ, we're going to go into the June 19th expiration cycle. And again, we're going down to the 80 puts and the $79 puts. And so I'm going to click on the 80 put. We're selling those. Going to click on the ask on the $79 puts because we're buying those. Off screen, you can see that it is 3 cents bid, offered at 18 cents. Well, gee, Pete, how am I going to get 20 cents for that? It's nowhere close. Look, everybody else is trying to sell it for 18 cents. We can't sell this for 20 cents. No, we can't. Going to need a little bit of help from this one. Got this nice volatile stock that's been closing on its highs. We need a little bit of a pullback. Something to the tune of maybe the $89 level, I think will get us filled. So let's hope for a little pullback in the stock tomorrow or Friday. But this is a normal expiration with 2.5 weeks till expiration. So we're going to continue to try and put this trade on up until next Wednesday's video. So to reiterate, we're selling the SQ June 19 puts. Those are the $80 puts. We're buying the $79 puts, and we're doing that for a 20-cent credit. Those are your trades for the week. So let me take a look as I wrap this up. I'm going to go into a couple of searches. If you are a swing trader, there are only a few searches that you really need to use. Now you can go in and use custom search, and I would highly advise you to get used to using a custom search engine. But for some of you, you don't have a lot of time after hours. All you need is 5 minutes. Come in, take a look at what's in Pop Bull. That's a great search. That's showing you lots of stocks that are moving higher and breaking out. So here you've got a bottom fisher that's breaking through horizontal resistance, SAVE. I would avoid all the travel and leisure stocks, all the hotel stocks, the casino stocks. For the most part, any sit down type of dining stocks, I would avoid all those. I think that we still don't know how consumers are going to respond to the reopening. We don't know if they're going to be opening up their wallets. We don't know if there's still fear about the coronavirus spreading. We don't know if the riots are going to continue. I would avoid this sector. There are plenty of other good sectors for us to trade. So if you go through this list and you take a look at what was breaking out and rallying today, airline, casino, Lyft, which has been hit hard because there haven't been people traveling in the cities, MOS, Mosaic. I like this one actually. That is a fertilizer producer. Nice breakout right in here. In my day trading video today, I suggested selling the $12 puts for 20 cents. Maybe there's a 12.50 puts. I think that's a decent trade. Sell those naked. Again, LVS, casino stock, airline, auto, bank, oil, casino, restaurant. So you can see that the theme has been a rotation into the laggards, and that's what I wanted to point out to you. So you need to be a little bit careful in just randomly selecting Pop Bull. These stocks all had really good momentum, but I would avoid those sectors that have been hit really, really hard. I'd focus a little bit more on tech stocks, healthcare stocks, maybe some financials. They're also doing pretty well. The difference between Pop Bull and Pop Plus Bull is that Pop Plus Bull stocks were on Pop Bull the previous day. And oftentimes when you run a search that has really, really good criteria in it, and if you don't take action on that stock that day, it's off your radar, it's gone forever. What Pop Bull does, Pop Plus Bull does, is it gives us that reminder. So the stock was on the list yesterday, but there's one more caveat. It has to be above the prior day's high. So we know that the stock was on the list yesterday. We passed on it. Today it's right back in our face and it's saying, hey, you passed on me yesterday. Here's your last chance to take advantage of me because I'm doing exactly what I was supposed to do. And in fact, you probably wish you would have taken advantage of the move yesterday. So yes, Pop Bull and Pop Plus Bull are excellent. I'm just going to really quickly go through this list. Stock like BA, I mean, this company is going to have a really tough time. They've got huge pension obligations. They've got lost airline orders because airlines are canceling, airlines going under. So there could be a oversupply of planes for the time being. People don't seem that willing to get back on a plane just yet. So yes, it's fallen hard, but I think Boeing has got some real issues. Plus, they had all the airplane issues and the lawsuits pending from all of that. So I'd be very, very careful with it. Can you day trade something like this? Oh yeah, I did that today. Did very well with it. Macy's, Casino, MGM, Wynn. You can see where JetBlue, Kohl's, department stores. you could see where a lot of the strength is coming from. So when I told you earlier, the dogs are barking, the dogs are barking. These are all the dogs are starting to catch a bid. This is kind of a neat little stock here, NIO. I've tracked that in the past. This is an electric car manufacturer in China. You can see how it's starting to break out above horizontal resistance here. Pretty decent volume. This is one that might be fun to watch for a day trade, maybe even a swing trade, but I'm always leery of buying stocks that are breaking out. Let's zoom out. You can see pretty volatile stock. It's been down to $1 and now up to $5, but worth watching. Something that's interesting. I wanted to make sure that I showed you Pop Bull and Pop Plus Bull. Those are two of my favorite searches. The other one that's excellent right now is Strong After Earnings. Go in, take a look at which companies in the last 2 weeks have reported. Look at that chart on low. That's a great swing trading opportunity. I think Dell presents an excellent opportunity as well. You can see the gap higher. It's through resistance, through the 200-day moving average. It's holding support at $48. I think any kind of little pullback in here, if you can get a decent credit spread off, maybe the 46, 45 put spread, I think that makes sense. It's a nice little breakout. Good little trade. DLTR, same thing. This one is starting to back off a little bit and test that 200-day moving average. I do like it below the 200-day moving average, maybe down to this $90 level. But yes, DLTR did really well. They were able to stay open during the coronavirus pandemic, so they made gangbuster money while that happened. You've also got this horizontal resistance level right here that coincides with the 200-day moving average. Yeah, I think DLTR could make sense here, but you want to see it come and test and start grinding higher and show you a little bit of relative strength. So right now I think it's still premature, but look how easy. You only had, what, 6 stocks to take a look at? VEEV, beautiful breakout. Stock able to hold the gains on the breakout. Possibility there. WSM I really like. Love that horizontal breakout there. 2 long green candles closing on their high. Bullish put spread right in here, probably around the $76 level. Lots of online sales. Online retailers are doing fantastic because they benefited from the virus. Yeah, ZS, another one. A little bit too far out of the gate. You can see I've got an alert right here. If that stock pulls back, test that open right there. Now I'm interested to try and sell an out of the money bullish put spread. I'd probably be trying to do it below this opening price right here, maybe using that $84 strike, 84, 83 bullish put spread, 20-cent credit, something along those lines. Again, my point is 3 really easy searches to look at every day. You come home, what happened in the market? I'll take a look at Pop Bull, see what's there. I'll take a look at Pop Plus Bull, see if there's anything there. If you want to apply some filters to it, you can. These are buy signals here, so it would have to have a buy signal on a daily basis and be on the list, and that will narrow that list substantially. So you can use a filter like that. Just remember to take it off because you may have searches that you run on your own, and all of a sudden they're being heavily filtered because you've got these on there. So Pop Bull, Pop Plus Bull, strong after earnings, you're a swing trader using Option Stalker. That's all you need. That's it for this week. Lots of information. Tried to keep it a little bit shorter for you. We need to be conservative right now. We don't want to spread our wings. We want to make sure that we get into these trades at our price, at a favorable price, that the stock has to do a little work, has to come in for us a little bit. And if they're really short-term spreads, then we want to make sure that we try and get that spread off immediately or we cancel that order. So the only one that fit that bill this week was AXP. We don't get filled on that by Friday's close. We cancel it, but we got to be very, very passive. We're trying to keep these inside of 2 weeks, and then we're able to reevaluate every couple of weeks. I'll be trying to get these done myself with one contract only so that I know if we got filled on them. That's how I know if I should include it in the track record, and also in the chat room, people are letting me know if they got filled. If you're watching the video on YouTube, know that it was recorded 2 days earlier for my members to give them an ample opportunity to try and enter the trade. But That doesn't mean that the information is not good. There's still lots of educational content. Oftentimes you can still get in on these spreads. So still really good actionable trades. But the most important thing that you can do if you're watching this on YouTube is go back, take a look at my research, take a look at the premise behind each one of the trades, see how those stocks fared over the course of the last 2 days, and then see if you think this research might be of value to you. I think my computer's telling me it's time to end. So that's it for tonight. Please subscribe to the YouTube channel and turn on your notifications so that you never miss these videos. Thank you. Have a good night. Thank you for watching this YouTube video. I'm Pete Stolzers and I'm going to keep the trade ideas coming along with lots of education. So make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.